Risk management was all about how much money I'm risking per trade compared to how much I'm trying to profit for each trade. Position management was all about managing the trade while it's live in an attempt to reduce the risk whenever possible, and yet still allow that trade to gather large profits. Money management combines everything and answers the following questions. How much are you looking to risk per trade? What's your profit target as a multiple of your risk? Is it 1 times risk, 2 times risk, 3 times risk? Which is it? And finally, the most important question of all. How many units should you be trading on any particular trade? What if you're trading gold or oil or currencies or natural gas? How do you know how much to buy of each? Actually, you know what? Let's go ahead and go through that. Let's talk about position sizing and go through this in detail. This is the absolute number one reason people fail in trading. Without properly sizing your trade, you end up taking too much risk or too little risk. With too much risk means you get emotional. With an emotional trade, your management goes out the window because you're up all night checking your phone just to see how your trade is doing, and then your fat finger is constantly moving that stop loss away when you should just simply close the bad trade. But instead, you end up losing all your money. All because you don't know how big your position size should be. Most retail traders have no idea there's an actual scientific way of calculating this. Most trading platforms don't have those tools available because if most people were trading with the size of positions they're supposed to be trading with, this would significantly reduce the amount of money the brokers would make from trading activity. And this is bad for business, so that's why you don't generally find these tools available on the platforms. However, most brokers offer the MT4 platform, and most people don't know that there's a feature that will calculate the size of your position automatically, directly from the platform. Very cool stuff, and I'll show you how this works in our MT4 course. For now, I'll teach you a simple 3-step process for calculating the optimal position size for any product you're looking to trade. Let's work through a real example on gold, and I'll show you exactly how this is done. Here's a 4-hour chart on gold. I've included the RSI and the MACD indicator on here just to help with the analysis. As you can see from this chart, gold has been trending upward over the last month and has recently built some strong upward momentum in the last week. As with our other examples, take a couple minutes and then perform your own analysis. Go ahead, pause the video, and see if you can identify support and resistance levels, divergence or convergence between momentums and price, any candlestick or chart patterns that are obvious. Seriously, put the video on pause. I really don't mind, and then play me again when you're ready to see my analysis of this chart. Here's my quick analysis of this gold 4-hour chart. First callout is the $1,600 psychological level. You can see there's a huge ceiling of resistance at this price level. Price climbed up sharply and was hammered down below the $1,600 price level. That's the first warning sign that the price may reverse in the short term. After looking at the last candlestick, it's pretty obvious that this candlestick is also far bigger than the average candlestick on this 4-hour chart. In fact, let's use the ATR indicator we've learned in a previous lesson just to see how this average move on a 4-hour chart compares to this last candle to put things in perspective. So let's go ahead and add that now. Okay, interesting. Take a look at the ATR price at the moment. We can see that the chart is currently showing the 14-period ATR at around $10. Quick refresher that this means on average, the price has moved about $10 for every 4-hour period. So in 4 hours, you can expect the price of gold to move up or down by about $10. Again, on average, and this is over the last 14 periods. Now take a look at the top right of the chart. I've highlighted the current candlestick in yellow and measured the size of it just to the left. We can see that the range from the low to the high of this 4-hour candle is around $38. Wow! That's almost 4 times the average move. There's a well-known concept in life and in trading and in statistics, and it's called regression to the mean, which basically means things tend to average out. When things go too far outside the average, they're normally pulled back in. In this case, when a candlestick moves nearly 4 times the normal range, it's more likely it will pull back, again, in the short term. So that's the second signal. Another thing that sticks out to us is that divergence between the momentum indicators and the price trend. You know what, let me clean up the chart a bit and draw a few trend lines on the MACD and the RSI. And I'll also draw some trend lines on the price chart for you just to show you how clear this divergence can be. Take a look. As you can see, the prices move from a high to a higher high. Look at number 1 and number 2 on the chart behind me. Pretty clear that this number 2 is a new high and trading higher than number 1. However, even though the price has moved up to a new high, both the RSI and the MACD momentum indicators did not create a new high. They created a lower high. This is a divergence between price and momentum. Momentum is heading downward, price is still heading upward. It's losing momentum, it's losing steam. So as you've learned, this is a sign that the move is losing momentum and a short-term reversal is likely. So that's yet another signal of a reversal on this same chart. Another simple thing to spot is the RSI indicator being above the 70 level. In fact, it's actually closer to 80 at the moment. This is another signal of a probable reversal, as you've seen before. And last but not least, before moving on, I want you to take note of that black MACD line right at the bottom in the MACD indicator. So the MACD line has crossed the red signal line from above. As you remember from previous examples, this is another popular signal suggesting a probable reversal. Okay, so a lot of signs hinting a possible reversal, but how do we actually set up the trade and how do we decide how many units we should be setting up to sell? After all, that's the whole point of this lesson. All the indicators at the moment are simply suggesting that we start paying attention to the chart and we look for a short signal, something more direct. At the moment, we just have signs saying price might go down and price might reverse, but there's no clear entry point yet, at least not one with a reasonable risk to reward ratio. So we simply wait and we see what happens. We never blindly jump in the trade. Well, that didn't take very long, did it? The next candlestick takes 4 hours to complete and we get a hanging man candlestick pattern. If you remember from our previous lesson that when a hanging man or a hammer appears after a sustained move, and especially near a support or resistance level, this presents a possible trade setup. Well, given how many indicators are suggesting there's going to be a reversal, and given the hanging man appears after price has been moving up for nearly 1 month, and it's appearing literally the period after a candlestick that's appeared in a trading range that was 4 times that of the average candlestick on this chart, this is an incredibly high probability trade, and we definitely would not want to pass this one up. Note a very important point here. Just because this hanging man candle appears on the chart does not mean we're just blindly jumping in and shorting the market right away. No, we still need a confirmation. This hanging man candle is that last piece of the puzzle in deciding how we're going to set this trade. So let's go through the simple 6-step process in setting up the trade for this chart. Step 1. Decide where to place your entry. In this case, we placed it just below the low of the hanging man candlestick pattern. If price trades below this low, there's a good chance it will continue lower after that. So step 1 is to decide where will you place the entry. In this case, just below the hanging man. Step 2 is all about your risk. You spent some time now analyzing this chart, so you should know where the support and where the resistance levels are. You could place your stop loss above the swing high of that large candlestick before the hanging man pattern, but that's pretty far away. Another possible level is above the high of the hanging man candle itself, but given how volatile gold has been recently, we want to give it a bit more room. Another reasonable area is above the $1,600 psychological round number. We've seen that this number acts as a natural resistance area, so placing our stop just on the other side of that is something we consider logical. Step 3 is calculating your risk. Most beginners are preoccupied with calculating how much profit they're trying to make, but the pros know better. They spend most of their time analyzing appropriate stop loss levels and calculating their risk properly. It's simple to calculate the risk. Simply measure the distance between the entry price and the stop loss price. As you can see, the entry price here is $15.81 and the stop loss price is $16.03. So the difference between both is $22. Thus, the risk for this trade is simply $22. Step 4 is placing your take profit order. This is easy because most of our trades use a 1-to-2 risk to reward ratio. So if you're risking $22 on this trade and you're trying to make 2 times more than what you risk, then your take profit will be simply $44 in this case. What you do is measure $44 away from the entry price, and that's where you're going to place that take profit order, which is shown as that green line on the chart. So far, so good. Pretty simple, right? Step 5 involves a bit of math, but super simple math. Calculating the size of the position. How big should your trade size be? Depending on your trading plan, you might be willing to risk 5% of your capital, 3%, 1%. Our trader in this example, he'll risk 4% of his capital on any single trade. Now, what does that really mean? Well, let's assume that the trader has a $10,000 account, and it's in US dollars. So what's 4% of 10,000? Come on, think about it. 4% of $100 is $4. So 4% of 10,000, you guessed it, $400. So that means on any single trade, this particular trader does not want to lose more than 4% of his trading capital, which in this case, if he's starting with 10,000, on his first trade, he will no longer lose any more than $400. So how do you work that out? How do you make this work with your analysis? The big question is, how many units of gold should he be selling so that he doesn't lose more than $400 if the trade goes sour and heads towards a stop loss? That, my friend, is simple mathematics, and you already have all the numbers worked out. All you need to do is take the maximum amount you're willing to lose on a trade, which we know now to be 4% of 10,000 or $400. So we're working with $400 is the maximum loss. And all you need to do is take that number and divide it by the total risk. We saw that the risk is simply the difference between the entry price and the stop loss price. And that was $22 in this case. So if you take 400 divided by $22, that will give you 18.18 units of gold. And that's the position that you need to take based on your analysis. And if it goes well, you'll make 2 times your risk. And if it goes bad, you're going to lose $400 on this trade, and it's capped out at 4% of your trading capital. It's as simple as that. Step 6 is actually placing the trade. Now, every platform is a bit different, but they'll generally have the same information. In this case, this order ticket has far more information than we care about. To keep things nice and simple, take note that the only items we care about for this example are those highlighted in green. Note the red star beside the 18 is for 18 units. Some platforms don't let you place partial units, such as this one, so rounding up or down in this case is fine. This is why the total risk for the trade is $396 instead of the $400 we saw in the previous section. Once the trade's set up and you've confirmed the order, all you need to do is sit back, relax, and wait for the trade to trigger. Or you can cancel if the price goes the other direction. Remember, we're looking for the price to fall in this case. Let's see what happens. The next period, the price pulls back hard and triggers our stop entry sell order of 18 units of gold at the price of $15.81. Now let's move forward a few periods and see what happens. The price pulls back nicely and brings our trade deep into profit. The price has moved more than $22 in our favor at this stage. Remember, the trader can execute a risk-free trade at this stage to effectively manage the position and eliminate his risk. So what does he decide to do? Well, in this case, the trader chooses to completely eliminate the risk and he brings his stop loss to the entry price, like so. Notice how our stop loss is now at $15.80.70, which is just a little lower than our entry price of $15.81. You know that nothing in life is free, and brokers need to make money too. That's why we add just a little bit of extra to the stop loss so that when we manage the trade, this 30 cents represents the spread that was charged to us when we took the trade initially. Okay, now let's see how the trade finishes. It takes about 3 days for the trade to finalize, but it's eventually closed with a $792 profit. The best part of a trade like this is the zero stress that comes with the risk-free trade. 3 days ago, shortly after the trade triggered, the price traveled far enough in our favor for us to move that stop loss to the entry price and eliminate the risk completely. This still left plenty of room for the trade to move and to continue down lower to our take profit level. This is the type of trade professionals take every single day, and this is how they're able to capture those large moves and generate excess returns.